Hi, this is Richard from eDeltaPro. Thanks for tuning in. Everybody loves a rising balance. Well, folks, this strategy keeps moving up and up. That's why I am happy to call it Calendar to Heaven. And we will be giving away some of the secret mixes, even to those of you who are not Led Zeppelin's raving fans, or too young even to know the band. Without further ado, let's jump right into it. I present to you the Calendar to Heaven. At the end of the video, I will be sharing the link to the backtest so you can look at the study in detail. Calendars are a very peculiar option breed. They involve combining contracts with different expirations at the same strike. To build one, we start by selecting the short contract at the desired delta. In this case, we are going to use a short put at 50 deltas. This short put will have 8 days to expiration. So a brief duration for this first contract. We will be adding a second contract. This time a long put at exactly the same strike. To accomplish this in our eDeltaPro backtesting software, we need to do a little trick. First, we add a long put. Second, we double-click it. Third, we anchor the long contract to the short one. This link between the two contracts will ensure that the strike of the dependent put will always be at a fixed dollar amount to the strike of the first contract. Using this feature, we can build, for example, a fixed width spread, like a $5 width vertical. For the heavenly calendar, we are going to set the fixed width at $0. In that way, we are assuring that the long contract will always have the same strike as the short one. With the individual configuration still open, we are going to set the duration of this long contract. We want the duration to be 28 days to expiration or 28 DTE. When we have a test with contracts on different durations, we need to tell the algorithm when to close the trade. For this study, we will close the trade using the front month expiration. That is the expiration of the contract with the shortest duration. In this case, closing the trade on the 8 DTE expiration. Our calendar will use the SPX index, and we will run this test over the last 3-year period. SPX options are also peculiar. They do not get assigned, and the weekly and monthly expiration settlement values function differently. For that reason, I recommend closing the trades 1 day before they expire and avoid all the complexity and gymnastics associated with the settlement value calculation. So let's fill the exit condition with 1 DTE. We ask the software to trade daily, so that a new position will be established every single trading day. This will increase the number of occurrences and improve the empirical relevance of our study. We are going to leave all the other options at their default value. We now have our basic configuration. Let's run the backtest. We can see the details results down here, or here on the mini cards on the right. Let me show you the results. As you can see, this strategy shows a nice consistent uptrend over the last 3 years. And although the winning rate is not very high, the fact that the losses are quite restrained in size allows the strategy to produce systematic positive results. One of the beautiful things about this strategy is that the short put ensures that you get a positive return if the price of the underlying goes up. At the same time, if prices go down, then you can expect the volatility to rise, thus increasing the value of the long contract. That is why I like to say that the calendar has a built-in hedge. A sort of self-contained insurance against downturns. That is why I love this calendar. The performance, even on downtrends, is still positive. Knowing that this strategy profits from increases in volatility, we may want to avoid trading it during high relative implied volatility, that is when IVR is high. So we are going to make this adjustment and test it to see if it works. We tested another adjustment, a stop loss. And even if we tested different stop losses levels during different periods, we found no evidence of a stop loss significantly improving the performance of our calendar. On the other hand, closing early when 20 to 30% of max profit is reached resulted in improved profitability, less time exposed to the market, and an increased P&L per day. We are going to use the group feature on this video. This one of the most useful features of eDeltaPro Options Backtesting Software. It allows us to make several continuous adjustments and save the whole sequence of tests. One click, and we will be able to compare several backtests in one single table. So here is the final setup for the calendar to heaven. Short put at 50 delta, 8 DTE. Long put at the same strike as the short put, 28 DTE. Trade daily. Trade only when IVR is low, less than 30%. Exit the positions if you reach 20 to 30% profit. No stop loss necessary. Folks, I hope you enjoyed this video and found the heavenly calendar as compelling as I do. You can start trading this strategy right away. And remember, always test before you trade.